markets, man. Just wouldn't understand.
Yeah, I'm too much of a boomer to get Dogecoin.
They're actually capital allocating, but they're capital allocating for which coins are the best, and that's providing a just unfathomable benefit to society.
I will be watching the non-fungible tokens and Bitcoin style things like Ethereum with interest, especially since it's going to impact my my line of work. But I am still skeptical of how useful it's going to be. I do think.
When's the CRA going to start taking tax payments in Bitcoin?
What's that?
When's the CRA going to start taking tax payments?
I already do.
Oh fuck!
Doesn't necessarily make it to their account, but I already take. I'll BF your account 6 months if you send me a little bit of Bitcoin. Know what I mean, buddy? Well, we can revisit your debt in 12 months. Just send me a bit of Bitcoin.
Send me 1/7,000th of a Bitcoin.
I think the problem with like Bitcoin is it just seems like a terrible model.
That's what I read about it. I got it, but I don't understand why the value is going up. Like when Bitcoin was worth $20, $100, whatever, I'm like, it makes sense. Like it's just kind of interesting, and you're not losing that much by having the value around there. But it's like now the value's like 40,000 or something retarded.
49,000.
And it's like how is there that much value in this like limited quantity of Bitcoins that exist in the world?
Well, it's the same. It's speculation.
Yeah, it's the same damn thing that's driving.
But aren't there are people who actually accept payment in Bitcoin and pay in Bitcoin, right? So like if you had Bitcoin, why would you ever buy something instead of just sitting on your Bitcoin? Like it should be like what's the term? Yeah, deflationary pressure. Is that deflationary pressure, I guess, when Bitcoin values are going up because people aren't spending them? Like fuck.
Well, I think the problem with Bitcoin right now is it would have to reach some sort of stability as a currency for it to like be actually used as a currency. And if it's not used as a currency, then what's the point?
Yeah, that's what I'm trying to get at. But
it's
like how deflationary pressure would work on Bitcoin. It makes sense that it would drive, as people sit on it and don't use it as a currency, the price goes up because they're unwilling to part with it. And then they'll only part for a higher price. And the price keeps going up. And then people really don't want to part with it because they really don't want to lose this fucking fast rising stock. And it's like, at what point is this actually supposed to be a currency people use?
I don't.
Well, yeah,
and it's just like self-defeated at this stage until like something else changes with the.
I've heard talk of stable coins, and that's something I need to Google because, like, just the name implies a coin that actually doesn't have wild fluctuations in value. But I haven't looked into whether or not that's actually something true or people are memeing.
I just think it's one of those things where it's just useless at the moment.
Well, and apparently it actually costs like a fairly significant amount of power to do a Bitcoin transaction.
Yeah. Well, that's the thing is, like, Bitcoin mining also validates all the transactions and such, and I don't even know if it's worth mining Bitcoin anymore unless you have like some sort of supercomputer. It's just really strange. It's a strange system. Limiting a number of Bitcoin in circulation is the strangest part. That's the part, like, from day one that I just didn't quite understand. Like, if it was
you have to, right?
And they came out at like a reasonable rate. Well, you have to like increase the difficulty of producing them, I think, but hard capping them, like, I believe Bitcoin's hard capped. It just seems strange.
Most of them are hard capped. That's what makes them.
Well, there's a lot that came out after Bitcoin that are hard capped, but I haven't checked out on like what's succeeded after Bitcoin. So maybe all the ones that are successful are hard capped.
Ethereum's worth 2 point 2080. My buddy bought a bunch of Ethereum when it was like $2, so he's fucking rich now. He might have actually sold it.
Sold it when it was $5.
Yeah,
Fuck,
probably.
150% gains, boys.
All right, well, that's actually a good segue into our topic today. And that's the stock market. So
No, this is a Bitcoin podcast now.
What's
Go
the
buy actually Dogecoin. Please pump and dump.
Elon Musk didn't make enough off GME. He's got to pump and dump Dogecoin now.
We're just a pump and dump podcast.
yeah, exactly. All 6,000 people who don't view this. So essentially the topic is just about the stock market after the fiasco that was the GME stock. The question was, well, I don't know about you guys, but I think this was the general sentiment, is we kept seeing the terms rigged and gambling thrown around a ton. So we wanted to dive into it and see if the market is really actually a rigged game, or if it is essentially gambling. So do you guys want to do a little bit of background information? I know that Howard's, you found some stuff.
Background information or thoughts before?
Yeah.
Or what?
Yeah, exactly. Like your thoughts before.
Well, yeah, I was just I've seen those sentiments a lot before in terms of like gambling and rigged. Actually, rigged wasn't as common prior to the GME thing, but I mean that was definitely tossed around a lot post 2008 crash, but kind of that died down a bit. But a lot of people that aren't invested in the stock market or don't invest in it will just say, "Oh yeah, it's a waste of time. It's rigged. It's it's just gambling. It's another casino. Like why I don't gamble, so I'm not investing." And prior to doing any of this research, I invest, and I just self-taught kind of. So you can use the stock market like a casino if you want. Like, I mean, that's your right. It's definitely, you can gamble on it for sure. Very possible, but you can also, use techniques to diversify your portfolio. That's a big one. Just diversify, and then it's definitely not gambling at that point. It's nothing's guaranteed, but it's virtually based on historical precedent. It's basically guaranteed returns. In terms of rigging, I think there is a certain amount of that. I read a book a while ago. I don't know if people remember it, called Flash Boys. And that book was about basically stock, big time stock traders trying to figure out how to get the lowest latency they could at the stock exchange, so they could get their orders in microseconds before other people to take advantage of the arbitrage. And one thing that happened is there's an exchange in New York and an exchange in Chicago, and the normal exchange used to go through like the regular internet connection, which is kind of like haphazard between those two cities. So one investment firm built a straight line between Chicago and New York, section of fiber optics, so they would have like a fractional advantage in terms of speed of communication between those two markets, so that they could take advantage of the arbitrage. So if something was selling slightly higher on the New York Stock Exchange than the Chicago, they could buy on the New York, sell it on the Chicago, and vice versa to make money. So like that stuff does stink of like rigging. It's like you're just using your huge wealth to
create more wealth.
Yeah, to kind of just take advantage and do things no one else has the ability to do. And I mean, you could say, oh well, they're just taking advantage. They're just providing a service of arbitraging faster between the markets, blah blah blah. So you can argue the other way, but yeah, there is instances that is pretty bad of that. So Yeah, for the most part, that was my thoughts. Is you can treat it like a casino, but it's definitely not. And there's some shitty things that go on, but that doesn't negate the fact that a layperson can invest and make good return as well.
Yeah, I think I didn't have too many complex thoughts going into this because I don't invest. I know a little bit about the stock market just this year. And with gambling, I feel like that was frequently thrown around as derogatory term by pretty much the hedge fund managers and financial advisor types, the financial elite, I guess, as if you aren't learned like us, you're gambling your money away and you shouldn't even be in the stock market. I feel like that opinion seemed to be prevalent, although it could have also just been that's the way people felt they were being talked to. And then on the opposite side, the people who were investing as small-time investors definitely felt the system was rigged against them and in favor
GME
of the big-time investors.
Right?
I'm just referring to like what I've seen for people talking about the stock market. Like the GME is the flashpoint where all of these were multiplied 100 times. But there's definitely a sense that these guys with their fancy computers and their algorithms and trillions of dollars to invest and blow up, pump and dump things and short 100% of shares of companies, just be able to manipulate the market just through the sheer volume of trading they can do compared to a regular Joe who can buy a couple stocks. It's not a fair and equitable playing field. I think that was well demonstrated by GME, but I think that sentiment has definitely been around longer than GME.
Yeah, I would mirror both of your sentiments. I think Hubbard's and Price. I don't have too much to add there. I think that the only thing that I would add is it's a pretty much the stock market, because I do invest too. If you treat it right, even though you're not going to be able to move the market and do a big pump and dump scheme and make a ton of money off of it, if you're just being prudent and sensible with it, you're not going to lose your money. You might go down, but you only really lose if you sell. So careful long-term investing it's very far from gambling. If you want to play a different game, then you can pretty much turn anything into gambling. You can gamble over the dumbest stuff you want. You can bet on, like literally anything. You can bet like what a TV series is going to turn out to be as it's aired live. Anything can be turned into a gambling game. But for the most part, I felt that before looking into this, it's only a gambling if you treat it so. And as for rigged, I think pretty much the same as both of you there. I don't really deviate from that. I think there's quite a bit of rent seeking going on, but how much it's actually just flat out rigged against people, I kind of doubt it.
I do think it's one point that Price brought up that I clarify there is like I've heard before the whole GME thing, a lot of like regular people that don't invest, saying it's gambling. And then I do think it's funny that the hedge fund managers and the business insider TV types, talking heads, kind of piggybacked on that sentiment and echoed that back, saying, "Oh yeah, you retail investors are just gambling." What I think there's a certain implication. Unless you invest your money with us, unless you put it into a management fund, you're just gambling your money away. So they kind of there was that there's two different groups that I've heard that sentiment from. Like one group being just people that don't invest ever and don't really understand finances, just who think it is a casino. And then yes, now that we've also seen the top financial elites saying that as like a warning to stop playing the game unless you play it their way. But those are two distinctly different groups that.
Yeah, it's true. It makes a lot of sense for them to latch on to that pre-existing sort of sentiment and use it to further their interests.
That's actually what I was thinking too, where it really did seem like there was a push to say, No, you guys, you can't do this. You're being foolish with your money. Please
Well, with
do
GME,
things in a different way, aka
there were
do our mutual funds.
people on television effectively telling adults in the same country that they shouldn't be allowed to invest their money as they see fit because they don't know how to do it and they're going to lose money. So they shouldn't be allowed to. And it's like,
Yeah.
wow, that's a hot take.
To be fair, I don't really think there's anything more American than like having the right to piss your money away or burn it in a pile. Like,
yeah, exactly. It's freedom, baby.
that's like the most American like thing I can think of is you as a regular citizen have the right to just burn a pile of money if you want by throwing it away on the stock market. That's like
Or by building your own Bitcoin mining farm.
doing like
that creates objective stores of value though, and like your graphics cards, which is it's a little bit of a yikes, Gotta go all in there.
and financial risk taking and insane financial risk taking is just like the hallmark of the American way. It's like so I just find it funny that
you're not a good American unless you got 2 bankruptcies under your belt.
At least.
Yeah, well, that's actually like America has bankruptcy laws in part because of those reasons, like so you can take financial risk because they know that it leads to financial growth as well. And then you just have elites coming on saying, "Oh, you can't do financial risk anymore. You're too stupid for it."
Yeah.
Well, we can get into it later, but I definitely have some theories on that just from watching those talking heads spout that garbage. But maybe we could do a little bit of background as to just investing in general. Well, I only did research really on the States since Canadian data is harder to find, but I found some interesting stuff actually. So
you researched the US, I researched the true stock market of
Tokyo,
Britain. If it's not on the London Stock Exchange, is it even a stock?
truly.
Oh yeah, you Britain. That's like so 1900s. I went all the way back to the Dutch.
The tulips, boys.
Yeah, I'm a bland person. So what I found was some rather interesting things. Back in about 2007, around 2002 as well, around 65% of Americans were invested in the stock market. So that's either indirectly or directly, so through their mutual funds, retirement, through their employer, that type of thing. But after the financial crisis in 2008, it dropped all the way down to 52% in 2013 and hasn't got above 55% since then. So there's quite a few, 10% less people invested. 10% of the total U.S. adult population are invested in the stock market than were before. I found that to be pretty interesting. And then some other facts that I thought were pretty much bang on the money. The wealthier you are, the wealthier the household, the more likely they are to invest. So one of the things that once a household starts making over 100K, it's almost 90% chance that they're going to be invested in some form of stocks. And if they have 100K plus income, their median holding is roughly 140,000. So as you'd expect, the wealthier you are, the more likely you are to be invested. But to be honest, still quite a few, even of the very low income households, so 35 to 53,000, 44% of them were invested in the stock market. They didn't have a lot. They only had about 12,000, so it's like 10-time difference. But even though it's 100K plus, so that could go up all the way up to whatever, right? But I was still surprised by just the level of investing. I would have thought it'd be even a bit lower, and then of course it breaks down by age as you'd expect as well. So a lot less people 65 plus are invested in the market just because they're likely going to be
pulling out
into bonds. Yeah, exactly. And then younger people are less invested too. Did you guys have any stuff? I got a few more things just on general background information that I found interesting about just general investing and education level on finances in the States. But
I wasn't really deep diving the general public's thoughts at all, so I found your stuff quite interesting. And I mean, you've got more to add along those lines.
Hubbard's?
Yeah, I didn't go too much into public sentiment or public, I guess, involvement so much. So if you want to add a few more points there.
Yeah. I'll add a couple more points and just voice my thoughts on it. So essentially what I found was people are also pretty financially illiterate. 53% of Americans didn't even know that a bond was the safest option. So when they compared bonds, real estate, stocks, and futures, 53% of Americans thought that the bonds were the safest, which is correct. But then that means 47% thought the other ones were the safest option, some combination, which is not great. So essentially, it seems
would you rather have territory or bonds in a failed state like the United States of America?
To be fair, just to clarify, those were U.S. Treasury bonds, not all bonds.
They're listed as U.S. Treasury bonds, so these are not like some random
shit bonds or
some shit company's bond, because that's definitely not safe. But just the research that I could dredge up on it is, it seems like Americans, but Westerners in general, but overall globally, people are pretty financially illiterate. Like they really don't understand what they had no idea what a bull market is, a bear market. They lack the fundamental basic knowledge of markets at all, and even just basic financial literacy in general. So just as a preamble to what we're going to discuss later, it kind of made me realize that there's at least a very significant chunk of the population that is absolutely uneducated about it. And whether you can point fingers all over the place, but it definitely seems like whatever sentiments are going to be swirling around, is a lot of it's going to be fed by just lack of information, lack of education, lack of like maybe, self-directed education. And then that was really about it for the background on that stuff, other than like some market background stuff, but I think that can come later. I didn't want to deep dive too far into this, because I think we could
I think it's a good setup we could move into GME and how basically this sort of financial literacy is hopefully on the upswing with retail investing.
Yeah, God, if Wallstreetbets is anything to go by, probably not.
But you have to be financially literate to appreciate the loss porn that you see.
Yeah, that's
right.
True. Like, red equals
that's
bad and green equals
for
good, and
financial literacy.
Really know. If you see the graph going down, bad. If you see the graph going up, good. If it's green, good. Red, bad. That's all they know. That and strike date and strike price.
See, I can say from personal experience that memes on Wallstreetbets certainly increased my financial literacy. But secondhand, because I wasn't personally on Wallstreetbets, but I was discussing the stock market with someone who's on Wallstreetbets. So then it was much more interesting once you know what puts are and calls and all the big moves you can make on derivatives and how you can lose more money than you ever had in the first place.
25 leverage. It's within my risk tolerance.
My personal risk tolerance.
Oh, man.
Yeah, so if one of you guys wants to dive into GME a bit, because I think that was the impetus for this entire podcast.
Well, like what happened?
Well, just what happened, and just that can kind of kick off like the gambling versus the rigged, right? Just a baseline overview.
Yeah, well, basically, GameStop, which GME is GameStop, obviously was not doing so hot because they're a brick and mortar game selling store. Games have gone online pretty much for buying digital download. It's like the big thing. And then coronavirus hit, so obviously in-person stores were hit hardest. So it was considered a pretty shitty company and likely to fail. So a bunch of hedge funds shorted the ever living shit out of it. And shorting, I don't know, sometimes gets explained poorly, but it's pretty simple at the basics. You borrow someone else's stock and sell it at the current market price with the expectation that you in the future will return that borrowed stock because you're expecting it to go down in price compared to the current market price. Therefore, in the future, you can buy it at a lower price and make a profit. So if you borrow it today and it's worth $100, sell it for $100, and then hopefully it goes down. Say it goes down to $10, you buy it back at 10 and return your borrowed stock there. You made $90. The problem with that is there's potentially basically infinity loss. There's no
stop on your loss.
Yeah, there's no stop. If the stock goes up to $10,000, $100,000, well, you have to buy it back and return the stock. So there's no cap on the upside. So there's no cap on your losses. And anyway, GameStop was hugely shorted by these hedge funds with the expectation that it was going to essentially bankrupt. And someone noticed this on the first guy that was kind of really got into it was what was his True Fucking Value was his name? Or Deep Fucking Value was and that was like last January essentially. Yeah. And he said that he likes the stock. It's probably not as bad as the stock as everyone thinks. It's making some moves and it's shorted to ever living shit, so it's probably actually gonna go up because the shorts are gonna have to cover and it's not a bad company. So he started buying the stock, and then over the next 10, 12 months, it started to gain some traction. His analysis started to gain traction. People started loading up on it.
I think one thing to add to the story is that while he liked the stock because of his fundamentals, also another very prominent, I think Deep Fucking Value is probably more famous now, but Michael Burry, who shorted the housing market back in 2008, he bought a ton of GameStop stock because he liked the stock. And what he did, he wrote the board of directors a letter about how they should start doing stock buybacks, which they did start doing while they were being shorted. So that also helped to push the stock price back up, and Michael Burry started getting out. But the shorts kept going, which is one of the other things that added into this whole fuel to the fire, because they kept shorting while there was also stock buybacks going on by GameStop.
Yeah, in the end, basically, the short interest was over 100% of the outstanding stock value or stock amount, and a bunch of retail investors essentially started buying it up like crazy to push the price higher, knowing that the shorts would have to cover and buy back the stock, which would push it higher, which would, and then that's where we got to the point where people were saying GameStop's going to go to $10,000 a stock, blah, blah, blah. And it didn't hurt that there had actually been several in the past. The most recent, I think the most memorable recent one was Volkswagen.
Yeah.
In 2009 or 8?
2008.
Yeah. And it went over 10x value. Almost
it became the most valuable company on earth for a day.
Yeah, and that was a short squeeze because it had been shorted, highly shorted, and people noticed, and it got a short squeeze on it, and that.
Oh, that one's a little different. It was actually only shorted about 12% of the stock, but only 45% of the stock was on the market, and Porsche bought 44% of the market stock without telling anybody. So then 12% of the stock had to be covered out of the 1% that was on the market. So Porsche made $10 billion that day.
Yeah, but it was similar because it was a short squeeze because
just one company that caused it, which was Porsche, which is kind of the funny part.
Yeah, but so basically the same principle applies where the amount of outstanding stock was massively overshorted, essentially. Mm-hmm. But yes, that arose from different circumstances.
I just think I'm not sure if this is the case, but I think the fact that so many people had stock here was part of why it didn't go fully to the moon the way it Porsche, the way Volkswagen did, because Porsche owned all the stock people had to buy, so they could just set their price and people had to buy it. Whereas this time, every retail investor had to set their price, and a lot of retail investors set a more reasonable price than they could have.
Yeah, I think there's might be that dynamic at play for sure. But anyway, it did go up like 100x over the months. And
oh yeah, it's crazy.
So, and then if in the frenzy, I guess a bunch of retail brokers stopped allowing purchase of the stock, and maybe Price, you want to cover a little bit more of the details of what happened there.
Yeah, that was one I was quite interested in, because that is the obvious smoking gun that most people pointed to when they claim the stock market's rigged for the big boys. Because if we were losing on a trade, they wouldn't stop our ability to buy stocks and make us lose harder. But with the hedge funds losing on a trade, all of a sudden you can't buy the stocks and make them lose worse. But in reality, the regulatory framework in the United States requires the clearinghouse to put up a collateral for every trade they do. And that collateral requirement is usually quite low. I believe in the single digit percentages, like 3%. But for a volatile stock like GameStop, it jumped up to around 100%. And these clearinghouses were undercapitalized, and they couldn't deal with that amount of collateral. So what they did is stop buying the stock so that they could continue buying every other stock on the stock market instead of having to shut down their clearinghouse because they had no money. And Robinhood actually runs its own clearinghouse and claimed not to have a liquidity problem because they took preemptive action, which was shutting down trading GME so that they couldn't have a liquidity problem, because they couldn't run out of liquidity because they couldn't trade GME. So it was all terrible marketing, especially on behalf of Robinhood, because they are their own clearinghouse, whereas most people are dealing with another clearinghouse that's a separate company. Well, I believe Robinhood is technically two separate companies, but one's Robinhood Clearing and one's Robinhood Trade. And it just looked awful, and they didn't handle it well.
Well, and I think one piece that's kind of important is they can't use the people's money that put money to buy the stock as the collateral.
Yeah, so that's why they need their own capital. They can't use anybody else's.
So people were saying, well, because that was something that people had used to dismiss that explanation, was that, oh, well, there was millions or billions of dollars being pumped into Robinhood just to buy GME. Why didn't they use that as collateral? They're not allowed. They're legally not allowed to use any of that money as collateral. So they had to find the liquidity from somewhere else, which they just couldn't do.
And the other big one was that they could still sell, which a lot of people were like, well, obviously that's evidence that it's rigged. But of course they can still sell because they don't have to put up collateral for selling. And plenty of clearinghouses were capitalized enough to make the purchases, but the retail investors didn't have access to those clearinghouses.
Yeah, they're using Robinhood, which is a very new broker. It's not something that's been around for 50 years and built up $500 billion in assets. It's like in this low billions.
I think the thing is they only have to put up collateral for the net position, and since everyone wanted to buy, it was all in the buy side, so sells actually reduce their requirement.
Oh, okay, so that's an added bonus to the sells.
Like it just, because Sally puts an order for 2 buy and Timmy puts an order for 1 sell, they just have to put the collateral up for the net one stock going X way, like as far as I understand it. So because all the action was in the buy direction, they knew they could safely leave the sell open without having it cause liquidity problems, from my understanding of it anyway.
But also the fact that other people could buy was because they were buying from clearinghouses that didn't have liquidity problems.
Yeah, and a lot of even some of the Canadian or some of the more long, in the U.S., the long established retailer traders never closed down buying, because
Yeah.
they run into the liquidity problems because they have much bigger, I'm sure, much more robust financial backing, such that they can wrestle up some liquidity much easier than someone like Robinhood, which is pretty shoestring.
Um,
Well, one of the funny things is Robinhood, I believe, got something like in the nature of $2 billion from a hedge fund, and people were saying this conspiratorially that, oh, that's a payoff. In reality, they got $2 billion so that they could open up GME for one stock per person, because now they had the liquidity to do that.
one of the things that I think prompted it, because there was an insane backlash against Robinhood and some of the other traders like Webull and whatnot. I think the thing that really drove people nuts about it was the CEO of Robinhood came on to the what was it, MSNBC Money, or was it NBC Money? I can't remember. One of the big money shows. He came on and he essentially said something that was like the first part, if you believe the first part, then the second part can't be true, and then vice versa. So what he said was, we did not shut down trading because like we were protecting our own interest, or the interest of the hedge fund, because there is a connection between the broker Robinhood and the hedge fund who were the shorters. So it's essentially the relationship, as far as I understand it, is Melvin Capital is the major hedge fund that had the big short position against GME, and Melvin Capital is backed by Citadel, and Citadel also is the major customer. It is the single major customer of Robinhood. So when they shut down trading, just the buy side, it seemed like they were doing it to stop the short position from being squeezed. So
yeah, and there's an undeniable conflict of interest there,
Exactly.
even with the full regulatory explanation.
Yeah, exactly. There's still a problem, but the CEO said, no. We didn't close down because of that. Like, that's ridiculous. We closed down because we had to essentially put up the cash. There's that regulatory, so we had to close it down for the regulatory problem. And then the anchor asked him straight up, said, well, okay, if you did that because of the regulatory problem, then that means that you have a liquidity problem. And he says, no, we didn't. We didn't have a liquidity problem because we shut down trading preemptively. And essentially what that means is we don't have a liquidity problem because we stopped it. So all it does is push back the argument. So they do have a liquidity problem, but he screwed himself, because if you actually believe that he doesn't have a liquidity problem, then the only real explanation that they shut down trading at all was to protect Melvin Capital and Citadel. Or if you believe that they have a liquidity problem, then his statement that they don't have a liquidity problem means he's a liar. So Robinhood has absolutely gutted themselves, and they're going to try to buy people's faith back with a Super Bowl commercial tomorrow. So we'll see how that goes.
Well, that's where all the liquidity went.
Yeah, $1 billion.
Well, I think the reasonable explanation of the liquidity problem is pretty evident, because a lot of the small time brokers were the ones that had to restrict selling or buying, and a lot of the big boys didn't. And so it does make a lot of sense that these.
Well, I think most of the small time brokers use a third party clearinghouse other than Robinhood, and I think there's two major clearinghouses that service these small time brokers. And according to Webull CEO, who did a much better interview, he basically said his clearinghouse called him up and told him if he sold GME on his app, they couldn't buy GME. So don't do it.
Right. Yeah. So they just didn't have the ability to actually allow purchases, so they had to restrict them because they physically couldn't fucking get the stocks to people buying them.
Yeah, because if Webull sold you a GME stock on their app and it said you have one GME stock and then you went to sell it, it's like, well, we can't sell it because you don't have it.
Yeah, they couldn't actually get it from the clearinghouse. So,
exactly.
I think that's fair enough. Like, I think that's a pretty reasonable explanation. I don't see any I don't see any deeper, more conspiratorial, nefarious explanations that actually make much sense.
So the Occam's razor, it's definitely the simplest explanation.
The one thing that does, I think all that aside, I think the most conspicuous and nefarious thing about the situation was the media coverage of the whole situation, because it's much more obvious that there was some really big amount of bullshit going on, because the business channels had a lot of people coming on basically saying, retail investors are idiots. They shouldn't be allowed to gamble away on this stock. They shouldn't be able to, I saw the dumbest argument ever that that was on almost every business channel, was like, how can we have speculation on a stock that doesn't warrant it from the fundamentals? And GameStop is not worth $300 a stock based on their business model. It's like, who gives a shit what their fundamentals are? That's irrelevant. That's not how stock pricing works. Are we gonna be the arbiters of what every stock is worth now? And we have some independent evaluator determine what's the fair level, and it can't go higher than that.
That sounds like an awful, like some other form of economy we know of.
And
work that way.
The best response to that all is like, what's more fundamental than supply and demand, dumb fucks? Like, the short sellers have a huge demand for the stock because they shorted the shit out of it. So, supply and demand. There's not a very big supply, and there's a huge demand. Price goes up.
So, and here's the thing:
101.
You're gonna have to do that for pretty much everything. Then, and then it's like, okay, well, should we set prices on? So right now, there's a huge disaster price you sent. I'm actually dealing with this at work. There's a huge shipping problem with the prices going crazy. Why don't we just set prices, limit the prices? Because why would you supply and demand? That's not appropriate. Why should it be that high? The fundamentals don't warrant it or something. You can make some sort of argument there.
Well, I think that's the point. My point was more like, it's a terrible analysis, because there's a million different reasons other than underlying business, and we allow every other sort of irregularity in the market essentially to go unnoticed or unchecked. No one gives a shit that Tesla adds a fucking Toyota every week in market cap. No one, nobody bats a goddamn eye about it.
Fundamentals are definitely better than Toyotas, so that's just fair game.
Everyone's just like, oh yeah, Musk is going to be pumping out 20 million cars on Mars a year in 10 years. Like, it's no big deal. Like, he's going to have the Mars market cornered. Like, it's a good stock. Like, so it's such a terrible argument, but it was parroted over and over and over again on mainstream news. So it's like, in this one situation where hedge funds are getting hammered, now all of a sudden this becomes an issue. Yeah. You guys don't talk about it until this particular issue. So
because your rich buddies were the ones who lost a bunch.
Was on Twitter. News companies were taking out ad space to tell people that the hedge funds had covered their short positions.
Yeah, so weird.
I was going to add that.
Evidence that they didn't cover their short positions if they're paying millions of dollars in ad space to tell people they covered their short positions.
Yeah, they would have covered it, and then they would have walked away, and that would have been it. Nothing
exactly.
would have happened. Exactly.
Well, and with all sorts of like nefarious, double speak and bullshit. Like they had someone from Melvin come on and say, "Oh, we closed out our position." Yeah, maybe you close out 1% of your position because you have it, subdivided into 29 different positions or whatever. You closed one of them out, so I guess you can technically say that on TV without getting your ass sued into oblivion. But like, it's just no self-respecting quote unquote actual journalists would let that kind of remark stand without challenging the ever living shit out of it. Like it's clearly bullshit. And then I was just gonna add the last thing. They were also then, a bunch of the news channels and stuff started, making noise about other investment opportunities to get people's attention diverted. Like they started pumping silver.
That was so funny.
Who in Wallstreetbets and retail investors start buying silver? It's like Wallstreetbets has never once looked at the commodities and said, yeah, fuck it, let's just pump the shit out of that. Like I'm so down for commodity and or precious metals. Like it's all meme stock shit. Of course it is.
Well, I mean, even if there's one post on Reddit about silver like 3 months ago, it doesn't mean Reddit's not, Wall Street wasn't plastered, post 1 to 100 with silver on whatever day that was that they were pretending that Reddit was caring about silver. There was no post that day about silver, none. So it's like,
actually we're saying like, what are you drunken idiots talking about?
Well, yeah, there was, but that's what I'm saying. There was no like people actually saying go buy silver on Wall Street's front page. Maybe there was a post about it 3 months ago, but like that's hardly relevant to today's situation. So, yeah, what I'm saying is just complete misrepresentation of what was going on to divert people's attention. And of course, like, I mean, it works on, say, something like CNN because, people that watch CNN probably don't know what Reddit is, don't know how it works, couldn't possibly which is sad. Like if they had the ability to type Reddit Wallstreetbets into Google, they would be able to verify it for themselves. But like, what percentage of that group is going to ever do that?
Well, and the wildest thing is when you go to the unmoderated, uncleansable parts of the internet, and all you see is just spam posts about silver and other meme stocks, and we're going to do a pump and dump on this, and it's like, this is a blatant disinformation. It's so bad. It's like some of the worst just internet what do they call them? They're like
astroturfing.
Yeah, like astroturfing, where you pay a company of like 500 people in Bangladesh or whatever to just go on the internet and spam this idea or this notion. And you see it all the time around politics. It's like around the election, the discourse on the internet that isn't moderated just goes to shit.
Or the discourse on the internet
exactly like that, but it was over a stock. It was the weirdest thing.
The same thing happens like even in the modded sites, depending on which ones. It turned into an absolute fiasco at election times in the major, like the biggest subreddits. They're just straight up propaganda. King.
But I guess there is a degree of difference. Like, and I mean, Wallstreetbets actually closed down during this whole thing for, I don't know, half a day or whatever to get more moderation and clean all the posts and get admin help to auto moderate a lot of the astroturfing that was going on. Because there was just
they lost the best. They got rid of the best mod, so it seems like something else is going on there now too. That subreddit's going to start, I think, falling apart.
Well, didn't it increase in membership from 1 million to 8 million in the last month?
Yeah, and it had already increased from like a few 100,000 to 1 million over the last like year. It's gone up like, I don't know.
Yeah, like that seemed like understandable growth, like a few 100,000 to 1 million, because more people are getting into the stock market, obviously, with not working.
Yeah.
But the 1 million to 8 million just seems like it really was the mainstream media driving people to check it out and subscribe.
Yeah.
Well, and I think a lot of the Reddit base too, getting a lot of the mainstream Reddit base also participating because they like the stick it to the man message.
Yeah,
true.
It's a populist.
It was like a populist event, so exactly. A lot of people flocked to it.
You got the populist right and the populist left. Actually,
even the politicians for both, the populist right and left were finally in agreement.
Yeah. So maybe we could actually move into the kind of like the main portion of the podcast. I think we've laid out a pretty good case for just some absolute tomfoolery going on within the stock market and within the media, or what could look like like bullshit going on, some rigging going on with the GME. So what did you guys find from your actual research, like in terms of, because the thesis that we had was, is the stock market rigged? Is it gambling? Like, what is it? What did you guys find so far from the GME fallout, but also just from generally looking into it? I know that some of it was like 2008 financial crash research.
The big thing I looked into is asset management, because I think the idea of looking at how managed funds perform relative to the terms often used are active funds, where somebody chooses what to invest in actively, or passive funds, where they just decide. For instance, the easiest one to understand is the index, where they're going to invest in everything in a certain market, so that if the market goes up, that fund goes up, and if the market goes down, that fund goes down. That's like the most basic passive fund. And if active funds are beating out the passive funds, I think that's kind of an indicator that, you know, they know something that's not widely known. They've got some sort of edge, so maybe something's rigged somewhere. And if they're winning, then also maybe it is more gambling for the little guy to not be in with these big funds. But what it turned out to be is basically a discussion of whether active funds have a role in the future. And usually they do like to say there probably is a role for active funds in the future, but that it will be much reduced compared to what it is now, because passive funds are absolutely dominating the stock market. It's people investing in a general fund that owns an index of the stock market is a much more reliable way to make money. Less than 1/3 of active funds a year beat the index fund. And over the last 15 years, only 13% of active funds have beat the index fund. So unless you're in one of those 13%, you're not doing better investing in those instead of the index. And in those 13%, they not only have to beat the index fund, but they have to beat it by enough that it justifies the fees you pay to the manager who runs your active fund, or managers, depending on the size.
Yeah, I think that's a good point. That I guess I wouldn't say it's rigged necessarily if active funds are beating out passive funds. You know, it might just be active managers doing what they're paid to do in a certain respect. I get like there might be sort of some smoke, right? Like, you know,
like it's not like rigged in like those super bad sense of rigged, but it kind of would be. It made me feel like an old boys club kind of thing, where if you aren't in, like, you're not going to do as good.
I just to add some further information there, there was just a report that I was reading on the notion that financial services is useless, because I think that's like a lot of like the people, kind of the end game of what a lot of people think about the stock market, and is that, you know, it's gambling and it's rigged and it's useless. Like, it doesn't, like, that's the other big thing, right? It doesn't contribute to society, because it's just a casino,
right?
It's just a self-enrichment scheme for rich people, or a casino for poor people. You know, it's just a waste of time and money and energy. And so I was looking a little bit at this, and this was taken out of the UK, this study, and they found for the year that they studied it, the financial sector had generated gross value add of 124 billion pounds, which was 7.2% of the total economy, or of the total value added in the economy, and $44 billion trade surplus on those financial services. So basically, the UK, one of their biggest, you know, trade exports is financial services for the rest of the world. And another interesting little piece of information that was in there was total compensation was 6.9% of the total compensation handed out in the UK. So it wasn't disproportionate to the value added to the economy, But interestingly, I think it was 3.2% of jobs were in the financial services. So financial services was definitely overrepresented in terms of compensation per employee, but it wasn't necessarily misrepresented in terms of its contribution to the UK economy. And then another really interesting part of that look at the financial services in the UK was they estimated only 10 to 13% of UK financial services was generated through trading and sales activities, which are generally like those are the type of activities that people would say are the most useless, the most like, you know, pointless and wasteful, and, you know, rich getting richer, you know, kind of circle jerk that you know exists as the trading and sales activity. I don't think most people really, maybe they begrudge banking, like kind of regular banking activities, but I think most people would agree, like, you know, banks having, you know, running checking accounts and savings accounts and lines of credit and mortgages, blah blah. That stuff's much more. I think they would find it much easier
There's
to
a lot
swallow.
of value added to people's lives by that.
They can see the practical purpose of, you know, and Visa cards and, you know, all those things that the kind of the basic financial transactions that we deal with. I think most people understand the usefulness of those. So, and those make up the majority of the financial services. So even if you say that the trading and sales activities are mostly not useful, well, that's not a big part of the financial sector anyway. And then another thing that gets tossed around a lot is that it's all like the big problem with the stock market is that it's just short term orientated. Like, you know, it's just the next quarterly profit is all that matters, and it just leads to terrible incentives and screws over society in general, because, you know, the financial sector only cares about the next quarter. I think there was a good discussion in here about how this is actually there might be some truth to that, but it's kind of comes from three different areas that the criticism can be separated out. And one is impatient shareholders who too deeply discount future cash flows. So they want the present cash is much more valuable to them, and they over discount the future cash flows. So they're not as concerned about the long term, you know, health of, say, a company. And then the next one was compensation driven management, who just focus on quarterly numbers because their compensation is dependent on it. You know, their bonuses are dependent on the firm's current income. Therefore, they're just going to sacrifice everything for that current income. And fund managers who the next one is probably what a lot of people get irritated about with the stock market, is that the trades are done so short term that, you know, it's hard to really tell, but it seems like the average holding period of a stock is only a couple months. So people say, well, yeah, it's, you know, if you're only holding a stock for a couple months on average, how can that be long-term orientated? I think the interesting thing to consider is, like, there may be truth to all three of those. I mean, they're not probably totally fair criticisms or totally true, but they all have different implications that people a lot of the time lump together. Like, they lump it together as like one thing, like the stock market is short term. Well, those are three distinctly different problems with different implications. So I don't know if you guys have thoughts on all of that.
That problem floated from a slightly different perspective, which is what I was talking about earlier with active versus passive. And basically the implication that these passive funds, it doesn't even matter if it's long-term or short-term, that they aren't inputting any sort of direction to the companies they invest in. Whereas an active manager in the past, and still today in an ideal setting, but often you have more of a pseudo index fund hedge manager where they like to own a bunch of stocks and it's kind of an index, but not really. But an active manager should be sending letters to the board and trying to get feedback about what's actually going on in the company, and like give their opinions on what's going on in the company and how they think things should be going based on the information they've got from the company. And what they found is when companies get on an index list, is that requests for information decrease, like Google searches for information about the company decrease, and the amount of people giving feedback to the company as shareholders decrease because the index funds now own a bunch of shares. But there's currently active managers can offset that. If there are enough active managers, it's not a big deal. There aren't negative outcomes to these changes, but these changes could presumably lead to negative outcomes if you really get a decline in requests for information. And the other thing is that in companies that have a lot of active managers versus companies that only have a few, there is an increase in creativity. I don't know quite how they measure that, but basically innovation increases with shareholder engagement.
I find that really interesting. Like, that's not something I would think would happen. I would think more people sticking their noses into things usually, because that causes problems so many times. But I could see if you had active managers who are actually very, very intelligent, who understand the business well, and also understand fundamentals of business in general, and they might be able to assist the company in spotting problems, coming up with solutions, that type of thing.
I think that's almost like giving active managers too much credit. I think there's a general value just in having to answer questions, even if they aren't reasonable, like fantastic questions, but having to have your information on hand and review it yourself and think, why is this person asking me a dumb question? Or like, how do I disprove this dumb question? Like, it kind of just brings you back into the mindset, or means you have to have the data on hand. Just at the activity level, I could see being more important than actually the quality of the discourse itself. Just having the discourse being the value.
Yeah, I used to work for a really, really big Canadian company, and I worked in the finance department, and I would actually sit in on the investor calls because it was a big pubco, and like the board would just get grilled like crazy by the major institutional investors. So these were the active managers, and they would just put the board through an absolute ringer. And I honestly could see the value in that for sure, because they were asking pretty smart questions too. These weren't dumb questions, and the board had to really understand what was going on in order to be able to answer them. Company still tanked, but
so I mean that's usually why the argument is made that active managers probably won't and shouldn't go away completely, but they are currently on the decline.
Yeah. Well,
to be fair, I don't think that it's dichotomous, though, right? Totally. You could see a future where large index funds, that's essentially their only involvement.
Yeah, they produce a group of high level active investor. I guess they wouldn't be the actual active.
Well, it's two separate functions, right? So just to clarify, right? Like there's active managers' main function in management of the firm's capital is capital allocation, right? They choose which companies to invest in, and that's where that's the fundamental break from passive investing compared to active. Is passive investing, nobody chooses. There's no one choosing how to allocate the capital. It's allocated based on the index allocation. It just tracks the index allocation. If Tesla's worth 5% of the index, you buy Tesla up to 5%. You don't care that Tesla might be overvalued. You just follow the index. Whereas active managers seek to choose which companies are going to succeed, which are going to fail, and buy based on that. That's separate from shareholder stewardship of the company, right? That's sitting in on board meetings, etc. You could just as easily see someone like Vanguard, who holds trillions in assets of different companies. They could continue to track the index, like they do now, but they could also have they could bring in the function of attending shareholder meetings in the same way.
Yeah, like that's true. But currently, just from what I was reading, the understanding of capital allocation, like as you're describing, what the function of active managers is, like they call it the search function. So directing savings to the best stocks, but it's also in the category of active manager. That was defined in the Economist was stewardship, which is like making sure that the stocks that they then invested in do well. That's part of the job of an active manager that was described in the framework I'm working with.
Right, but what I'm saying is those are two very different functions, and you could foresee a future where you still don't have much in the way of search function, but you do have more in the stewardship function, right? Of say index fund bringing
index
in
funds could invest in stewardship, kind of.
Yeah, it was separate from the search function. They still don't spend because, as far as I know, the biggest portion of the money spent on active management is the search function for most management firms.
That's definitely true, because that's where I see the discussion that it is correct that active management is declining, because their like value added is in the stewardship aspect, but most of what they actually do is search oriented at the moment.
Yeah, so so I think there is a future where you have stewardship index funds that do something in the way of stewardship, because you wouldn't have to, I don't think you'd have to raise management fees on index funds very high when there's trillions of dollars under management to still have some level of stewardship that is meaningful.
That's true. I think from what I read, I would make the inference that the reason you don't see that now, like you don't really see stewardship from index funds now, is that they've kind of been in a race to the bottom for getting rid of fees at all costs. So maybe as that becomes less of the driving factor of which index fund you go to, like because they all have super low fees, maybe it will start to matter more for the index fund.
You might actually start adding to your return by developing those people who can come in and speak and ask.
The thing is, if you had a stewardship as an index fund, I believe that would probably benefit every index fund, unless I'm thinking of something wrong, because the other index fund owns all the stocks you own as well. So it's also tough to separate from the search function, because essentially your recourse is limited, right? Because you're an index fund, you may ask tough questions, you may have someone who goes to the shareholder meetings, but you don't have the threat of selling out your stocks, right? You know, the person representing you at the shareholder meetings asking these tough questions or whatever, well, you know, the board of directors can just say, you know, go fuck yourself. Like, what are you going to do about it? You're an index fund. You're selling out. You're not going to sell your stocks. You're not going to tank our stock price. You can't. Yeah.
So it is hard to separate the two, but I think it is, in terms of active versus passive, there will be if passive gets too big, I think then the opportunity for active starts to ramp up, which increases the return for active, right?
Yeah, it'll find an equilibrium, right? Like,
yeah, exactly. So I think it's. I think most people hope so. It may play out differently, but I think there is some sort of.
I think the algorithms that get so goddamn good.
Reason to believe that there is going to be an equilibrium found in that type of system, so it's not the end of the world.
Yeah. As much as this is actually really interesting conversation, I think we should probably direct it a bit back towards the main thesis, unless you've got any things to tie out here.
Well, that's about it for the active versus passive, I think, which, yeah, we can go into other aspects of whether or not it's gambling or rigged or.
Yeah.
Well, I think the one thing that really ties the active versus passive conversation together with the rigged conversation is I think a lot of the people that have succeeded as retail investors, it's on the back of the rise of passive investing, right? Like, a huge part of the rigging of the financial services was, if there was probably the most egregious examples of, rich people in the know taking advantage of, retail investors or, the less wealthy people without much knowledge, was people selling these active funds that they knew were, not going to outperform the market at a 2 or 3% expense ratio, to average Joes just looking to get a retirement fund together. And lo and behold, here comes passive index funds that have, some of them now are bordering on free, no management fee. Like they're literally down to like 0.01% of your fees, right? And some of the worst funds were crazy. They would have front-loaded fee requirements, so 5% of your initial investment is just trimmed off the top, on top of a 2% fee. They'd have back-end requirements. Like, that was some of the most egregious examples of the financial industry taking advantage of people with less knowledge just by selling them garbage. And skimming it off.
It's also interesting because index has blown up in recent years, certainly for retail investors, but apparently the first good indications that a lot of active managed equity funds weren't getting a return on investment that the average market was seeing started coming out in 1968 from what I saw. Like, that's when like people in the know started to realize that human beings weren't actually very good at picking stocks.
Well, that would have been around the time when Bogle was doing all the work on that.
Yeah,
and that's when he's the one that started Vanguard and got it, started. And now it's taken off to a huge extent, but it's been around for a while. And like I said, that is where you can self-teach yourself a lot of the, like, index funds are stupidly easy to understand once you go into them, right? It just tracks the index. It diversifies for you, which is takes a lot of the risk out of the stock market. So it automatically lowers your risk, and you pay no fees. Like, it's a huge win for retail investors looking to stop getting screwed by the financial industry, right? Like, active wealth management was if there was an argument to be made for, a scam or, rigging or some sort of slander against Wall Street, that's a big one.
Yeah.
Yeah, I definitely agree there. That one, I look at the fees that when I was trying my very best to get the fees down to zero, but you can't really do that in Canada. But as far as I could, some of the offers I got from RBC, from CIBC, they were just atrocious. And I wound up going to Questrade, which was, significantly cheaper. But if you really don't do your research, you're gonna get just screwed so royally on it. And I do think that it's a very good point where, if you want to talk about rigging, that's probably where it occurs. Where it's the same type of behavior that occurs in like any sort of industry where people, pull the wool over the customer's eyes. But I think it's particularly egregious with financial products. So, do we want to talk about anything else for rigging?
I think there's just a couple more things to touch on in terms of like perception of the stock market in sort of rigging. One is just like the complexity of the markets, right? I think complexity continues to grow with new financial instruments, and I think 2008 was a representative case of that. Like, to explain what really happened in the 2008 financial crisis and to really understand it, you need a decent understanding of some financial concepts that a lot of people just don't have. Like, it's not insanely complicated, but some of it does get pretty in the weeds with a mortgage-backed
jargon.
Yeah, like mortgage-backed securities. What does that mean? Well, you need to know what a mortgage is. You need to know that mortgages don't usually stay with the original lender. They usually get sold, and then they got sold by the thousands and packaged into securities that were then sold. Shares of those mortgage-backed securities were sold off, and then that increased the demand for mortgages because they needed more mortgages to build these mortgage-backed securities, and then that forced people to adopt lax lending standards, and then all sorts of things like derivatives and CDOs were put on top of this, and the derivatives of these things were where it started to get really complicated, and there was synthetic derivatives on top of the first layer of derivatives, and even as someone I have a decent background in finances, like economics degree, and I know some accounting and stuff, and it's like a lot of that stuff just starts to get bizarrely complex, and you just start to question the necessity of it. It's like, why did someone need the ability to bet on the U.S. housing market through a derivative or synthetic derivative? Like, was it really necessary? It was. So that, I think the complexity and just like the excessive layers of derivatives and stuff does start to make people perceive the stock market as kind of a black box that only the elites really understand, or only the elites can really access, because it's just, the information is so complex and esoteric, a lot of it.
Joke's on them, because they haven't realized that even the elites don't understand what's going on.
Oh yeah, that's absolutely true.
Well, I mean, they nearly caused a worldwide depression because they wanted to fuck around with the U.S. housing market. Like, yeah, they clearly don't know what they're doing. And the other, this is, I think, a small piece of it, but I think it is a meaningful piece of the puzzle, is finance is super elitist. The top schools in the U.S., it varies between Ivy Leagues, but about 40% of Ivy League graduates go into finance and consulting. And the top, Wall Street firms, they spend hundreds of millions of dollars on recruitment from these schools. So it is elitist. It straight up is. They go to the best schools, and they go specifically to the best programs in the best schools to get the cream of the crop of Ivy League graduates every year, and then they work them 100 hours a week until they burn out or make management. So yeah, people can't help but feel shut out if the only way to even work, nobody probably, your average person probably knows no one that works at Goldman Sachs, because Goldman Sachs only hires Harvard and Princeton and etc. graduates.
Yeah,
so
I've met one guy, and I'm in that industry a bit, and I know one person who works there.
Exactly,
and
like
it's an internship. That was it. It was a top flight Canadian school guy.
Exactly. There's very few people that, like, it is a kind of a closed bubble, and there's no one, your average Joe doesn't just interact with anyone that works in these industries anymore. It's just, investment bankers that live in there.
Hence why the GME thing turned out to be a bit of a populist revolution, right? Quote unquote revolution. I think that's, a lot of people are perceiving it that way. It's like, well, these are just, the Wall Street fat cats.
And I think that's also where some of the sentiment around, like, socially useless comes from, right? If you see year after year some of our most privileged and educated people, and they just go into these finance jobs, it feels a little bit, people can start to get a little bit cynical about that. Like,
well, what you would expect, like, the geniuses from Harvard to go do is to go work in a science laboratory like AT&T Labs or MIT's research department or something like that and start building the cool stuff of tomorrow, but not go, go be a bunch of rent seekers and parasites on Wall Street is the theory. I'm not
Well,
saying
and
they actually are, but that is kind of...
Yeah, I think that's important to note. Is like I think our financial services are important, but I think our financial services over rewarded and overemphasized. Maybe there's an argument there, and I do think it's interesting that there does seem to be, like, say someone like Elon Musk. I think the reason that a lot of people like him, he is controversial, but I think there's a chunk of society that likes him because he's perceived to be doing something real. He's clearly a genius, whether or not he's mentally deranged or not.
He's a stable genius.
Yeah, like exactly. Whether or not he's mentally competent, or just deranged to an extent is besides the point. He's clearly a genius. And what he decided to do with his genius is create tangible, real things. He's sending satellites into space. He's building
dead hookers in car trunks into orbit.
He's putting electric cars on the road finally. Dragging you
stuff.
Yeah, dragging the U.S. into the electric car age. One step at a time. And I think people just respect that hugely when most of the time they just see elites. What are most other elites doing there, or quote unquote geniuses, top graduates doing their corporate lawyers negotiating whatever, some esoteric complex contract bullshit.
Even your eyes glaze over the second.
Yeah, or they're creating some trading algorithm, or they're doing some other seemingly, and some of those things do, I'm sure, add value to the economy, but it's hard to really grasp what they're adding, and it's hard to compare it to someone like Elon and say, I'd rather have such and such working on a trading algorithm than compared to Elon, making electric cars.
Building cool stuff that maybe I'm going to get to own in the future. I would absolutely agree with that. Well, I think Elon Musk there's quite a bit of people who don't like him. Now just
I think it's more personality based than anything.
Yeah, but he is definitely lionized and hero worship by a chunk of the population,
he has a big subreddit devoted to him that just absolutely worship him. It's like 500,000. It's quite a bit.
And I think that doesn't come from the fact that he's. I think a big chunk of that respect and hero worship comes from the fact that he actually puts products, tangible, beneficial products, into production and gets shit done. You can see the impact of his companies and his endeavors, where it's hard to say the same about a lot of
people don't even know what Goldman Sachs does, right?
Exactly.
Are they a bank? Are they what are they? It's they don't even know. I would say that. Is there anything else for the rig game? Because I think we could probably, unless there's some other things, we could probably move into just a little bit of gambling. Is there anything else that you guys wanted to tie out there?
I can't think of anything.
I would say...
Yeah, go ahead.
I would say, one thing... From what I learned in terms of, it being rigged, is what I kind of thought before. There are always going to be little things that are not above board, and maybe that's quite a bit of it. And we don't really know how much of the stock market is actually pure rent seeking, but I certainly think from just being in it myself and just just being and doing the reading, I honestly feel like it's the best time to be in just a regular Joe investor. It looks like the bull run's going to be ridiculous, and yes, we're going to have some crashes, but if you're just an everyday Joe, you can put in a lot of money and still, or even a little bit of money, and you're still going to make very good returns if you just use the smart way. So even if there is some rigging going on, I never really saw anything to make me think that it's actually a problem for the general normal person. It's like, yes, okay, there's some bullshit going on, but there's bullshit in everything, and it would be good to try to dial back maybe some of the, all of the people going from Harvard into the stock market, into finances, just because that's, it would be way better if we're building like the next new technologies and cancer cures and that type of thing. Like, I would much prefer the money to go into that, but overall, I really don't see a good argument to indict the whole thing. I think I just think there's absolutely no evidence or no reason for people to do that, other than I think people they're really truly, they have no idea. Like I was saying about Goldman Sachs, it's like they don't even know what the company is. They have no, even fairly educated and regular people, like even some family members I know, they really do believe it's kind of like this weird rigged game again. So they don't even look into it. And just a day of reading about it, one day you'd be able to figure out like, this is actually going to be where I can make some money, so long as I'm sensible about it.
I just want to point out, any Joe Smo could invent the cure for cancer, the next great technology, but it takes a true genius to understand how to allocate capital to the guy who's working on the next cure for cancer or great technology.
Yeah, that's true.
Well, I think the couple things, to just to wrap it up, like the optics are definitely bad around Wall Street and the financial system in general. Like the bailouts in the wake of the 2008 crisis, I think there was a misunderstanding, right? What exactly those were. I'm sure there was some money that wasn't well spent in that regard, but a lot of it was just quantitative easing to get liquidity into the market. But if you don't understand like how that works, it can just seem like 700 billion could change, so many, Americans' lives, right? Like you just think, 700 billion, that could change so many lives, not realizing that it is changing so many lives by avoiding the, Great Depression 2.0, right? Like, there's a lot of things that the optics of it are just bad, and I don't really know how, Wall Street or the government or anyone else can really do a good job of making the optics better, just because I think a lot of those things, people don't understand marginal tax rates. You hear things like, I didn't work overtime because I'd actually earn less because I'd go over the tax rate.
That is just such a common myth. It actually hurts my brain.
Or one of the ones that actually makes me just sad to hear is like, the company doesn't care because it's a tax write-off. It's like, they still spent the money. Like if you spend $100 and then you get a $40 tax credit, you're still out $60. It still cost you $60 net. Like it's not free. You didn't get it for free. Just because it has a write-off component doesn't mean it's free. It still has, it's still $60. Like it's just, so if we can't correct like basic misconceptions like that at this point, like I just don't know how you correct misconceptions that are even more complex. And I'm sure, I'm sure some of the bailout money did not get well spent, and I'm sure some of the bailout money, now sounds like a couple trillion is coming down the pipe for coronavirus. I'm sure some of that won't get well spent. But that being said, I think the couple things that people should keep their eyes on in terms of valid criticisms that are pretty easy to understand is capital distribution. So yes, Joe Smo can make a lot of money. You can get into index funds and you can make a solid 8% or whatever. But if you're starting with $10,000, 8% on 10,000, it's going to take you a while to make something really life changing. If you have $100 million, it's 8% is going to start to sound a lot better to you. So the fact that there's just a fairly high degree of wealth inequality means that even though the market's open for everyone, people do not have equitable amounts of capital to invest, which, that's never going to be, we're never going to even it out totally, but people should keep that in mind, that wealth inequality matters a lot in a system where you can get a fairly good return compounded over the years. And number two is taxes. Like, why are capital gains taxed less than wages? It's, you get taxed less on something you didn't earn the income through working. You just did it by having capital. There's no fundamental reason why capital gains get such favorable treatment by the tax system. Even Warren Buffett has come out and said, like, why in the seven circles of hell do I pay less like a lower tax rate than my secretary? Makes no goddamn sense. Like, this is screwed up beyond belief. So there's definitely, a case to be made that, fixing how taxes work could help a lot of the problems with that.
Yeah, I would agree that the tax issue is definitely seen as, I would say it's a contributing factor to people looking at it and saying, like, well, it's just rich guys giving other rich guys breaks. And I would absolutely say that is the case, at least in some degrees. But yeah, I don't really have anything more to add on the rigging side. Do you guys?
I think we can go with the gambling.
Yeah. For me, when I looked into this, I think this is just gross misinformation or just lack of education when people think that it's gambling. Like, I really didn't have my mind changed in any way when I started reading about this. Like, from my initial thoughts, it's exactly the same thing as I thought, and the same thing that you guys voiced. You can turn anything into, like, a casino. Anything that you can think of, you can gamble on. And if you're going to be unprepared and you're just gonna YOLO it into whatever to try to make a quick buck, like, you're gonna get burned. It's just gonna happen. There's no, like, I've done a couple of, like, YOLOs, and I made some good money on some and then lost money in others. It's just like, that's the way it goes. But on just the regular index funds, I've made a ton of money even in the last year. And if it drops, you just got to make sure that you don't sell. So being responsible and treating it as a long-term strategy, and you're patient and you don't panic and do something stupid, it's completely like, there's, if you are, I always put it this way, if you're invested in a proper index fund and that thing goes to zero at some point, guns are worth way more than that damn thing ever was, because the system has completely collapsed and we're now dealing with either human beings have phase shifted into something different, or society has completely fallen apart. So there's no argument to be made that, like, just in general the stock market is gambling. It's all about how you treat it. It's just like, anything else, a fantasy football. That doesn't have to be gambling at all, but you can turn it into a big, gambling mess if you want. It's just about how you treat it and how educated you are and how careful you are about it.
I think that's true to a certain extent, although I think it's something akin, I don't know, almost like losing weight, where, like, the knowledge behind it is really, really simple, but it's really hard to put into execution for a lot of people. Even though, for losing weight, right, I think most people can grasp, if you burn more energy than you take in, you're going to lose weight. Pretty straightforward concept, not very difficult to understand. But a lot of people struggle with it still, because it becomes, they run into all sorts of, problems with actually being able to control their eating or get proper exercise, et cetera, et cetera. I think investing a lot of the time is the same thing. Like, most people understand, if you want to, save your money. If you want to save money, invest it and get wealthy. Pretty straightforward. You have to spend less than you make to generate the savings, and then you have to put that in. And if you want to, there's a lot of pitfalls that you can do by single, YOLOing it on single stocks because you think it's a get rich quick. There's all sorts of options trading when you don't know what you're doing to try to beat the market. Blah blah blah. There's all sorts of pitfalls, but the general method of investing in a well-diversified portfolio and just investing for the long term, set it and forget it. You take your paycheck, you save whatever percentage of it, put it in a diversified portfolio, you forget about it. 50 years later, you have plenty of money for retirement. People just cannot stick to the plan. And, you can go on, any internet forum that regards to like personal finance, and you can find stories of people who knew better. They'd say, I've read all the books, I've read all the investment books, I've read the math behind index funds, but I saw, GameStop going through the roof, and I put my life savings in it for the memes. And
YOLO my dentist school tuition.
Yeah, it's shit like that. I my friends were making a killing on whatever stock, and I just couldn't wait. Or Bitcoin was way up, and my coworkers were, talking about retiring on Bitcoin. So I put in my life savings and then forgot my wallet password. So that people just, it's so much harder to stick to the plan because and I think it's almost like the knowledge is easier than ever to get, but the amount of noise and distraction and enticement to fall off the path is higher than ever as well. Like you just have so many people telling you, this one quick, real estate trick that will get you wealthy or blah, 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 blah. And you see all the winners on the Wallstreetbets who making millions off of this YOLO trade and,
GME.
Exactly. And
I would absolutely agree. But what I mean is it's not gambling in the sense that the inherent nature of it does not make it gambling. But I do agree that it's very easy to fall into a gambling pattern. And I think it is one of those things where, especially nowadays, with always being peppered by messages of look at my game porn, look at my game porn, look at how much somebody I know actually or know of within my social circle made a ton of money off of GameStop, hundreds of thousands of dollars. It's like some dude from the island, a couple from the island that I know of made a shitload of money on it. And then you also see all the messages all over the place, right? In your Twitter feed, in your on Reddit, on if anybody uses Facebook, right? I do agree there, but I think my main point was it is what you make of it, and inherently it's not gambling, but it can easily turn into that.
Well, I'm just saying, I think I agree. The only problem there is it's easier said than done for a lot of people. Mm-hmm. And, I think some of the people's sentiment that, that it is gambling, it doesn't only come out of sometimes it's born out of personal experience with their inability to treat it as anything other than gambling, right? It's a hard learned lesson where they got into the stock market and it just became, a gambling outlet for them. And they've now since written off the stock market as gambling because that's the only way that they were interacting with it and really capable of interacting with it in terms of emotionally, right? So I don't think it's necessarily
it's inherently gambling for some, maybe not inherently gambling for others. It just depends on personality types.
Yeah, and I think it's not wrong to acknowledge people's maybe inclination to state that if that's because they will treat it like that. And I don't know, maybe there's some strategies that they could employ that would help them get out of that mentality or avoid it, but it's an individual kind of internal battle that they're going to have to undertake.
The way that you actually do it is you restrict people's ability to burn their money, because that's what the talking head said. They're too stupid. So that's the solution.
To be honest, like, you say that as like a joke, but I mean, that's essentially what CPP is and Social Security,
old age security and whatnot. I was just gonna say actually we do have a solution for that.
Those things exist because people, the government is well aware that people will essentially, a good chunk of people will burn through all their money that they make over their lifetime, and unless you force them to save, they will not, and they will have nothing left when they are in retirement. And
so in my background research for this, one of the interesting things that I put in there was there's this retirement preparedness survey, and it was more than a third of millennials. This was done in 2018, so it's not like this was done in 2004. More than a third of millennials say that they do not see the point of saving for retirement, since anything can happen by then. And most millennials are 30 plus at this stage. There's only a few of them who are in their mid-20s. So these are not people who are, 18 to 19-year-olds. These are like, up to 40-year-olds who are saying this shit. And
they're chronologically 18 or 19, but like mental age, a little different.
Well, yeah.
Well,
but what I mean is, like there's, if you have a decent chunk of people thinking that way, over a third of people who are not just literally kids, well into their 30s, who are thinking this way, then it's not a bad thing to have the government at least say, okay, well, we know that you're going to do something absolutely brain dead with your money. We're going to lessen the burden on the rest of the society to make sure that you're at least somewhat taken care of. Like, I know quite a few people who are in their well into their 50s and 60s who have not a dime saved, and they have zero thought of doing it. They don't care. Okay. It's going to be a fun time for you.
Yeah, I think the government, so the government does have a place in kind of forced saving for people, but that is because people, in a perfect world, I wouldn't want to pay into the CPP. The return on the CPP is not great, essentially, but I understand why we have to do it. And, libertarians, this is, I guess, the degrees of freedom in society. This kind of comes into question. A lot of libertarian types will say, well, I shouldn't have to pay into the CPP. I should be able to keep my CPP, opt out of it, get the CPP money, and I'll save for my own retirement. The problem is,
well, most libertarian types wouldn't even save for their own retirement. Let's be serious.
Well, the problem is that only works in a society that's willing to let people basically starve and die if they screw up, right? And our society is just shown time and time again we're completely incapable of that. Like, we're not capable of libertarian sentiments of where, you've made your bed, now you have to sleep in it. We don't do that to people. So what would happen is people would just essentially, everyone would opt out of CPP. Everyone would, half the people would just waste all that CPP money that would have otherwise gone to CPP. They just waste it as extra disposable income. And then when they hit retirement age, they would live on the government dole and, some sort of social assistance that basically replaced CPP, because we won't let people starve to death. And then the government would just be footing the bill anyway, but not have any income from the CPP to offset it, and we'd go broke. So that's why.
Well, then they would starve anyways.
Yeah, so we do need to have forced savings mechanisms, and I think so that's where some kind of argument in favor of, like the talking heads restricting trading because retailers don't know what they're doing. I mean, we already kind of do already make choices in that direction in terms of restricting people's ability to do what they want with their money, based on, quote unquote, the government knowing what's best for them. although I think in terms of when it comes to the stock market, I don't see any strong argument of that being a good thing. Like
of
it's just
placing the restrictions in at that point.
yeah.
Right? It's like you need to take it off at the source.
Well, and there's the issue you run into with just whenever you speak about politics with regards to welfare and limiting people's ability to harm themselves, with almost everybody deciding to view it as a black and white system, when in reality the systems that work best always have it as a gray area. It's like you want some social assistance because a lot of people will need it, but you don't want to just take away freedom to give social assistance. So it's always a balancing act.
Yeah, and I would say, like, I think all the indications to me, one freedom we definitely shouldn't take away is people's ability to buy whatever the hell they want at whatever hell they want price in the stock market if they think that's what they want to do. Like, increase the CPP contributions or the Social Security, I guess, in the U.S. if you want people to be more protected and with their money or save more of their money, forced, like increase payroll deductions or something, but don't start screwing around with that. I don't think any of those talking heads believe in that anyway. They just wanted to, it was all just a smokescreen to protect their hedge fund buddies. But
yeah, there are better and worse ways of achieving that balance, and I think going after the stock market and restricting people's ability to purchase it and burn their money is definitely on the bad way of doing things. Do you guys have anything else? Any closing thoughts? Did you guys?
I do have one last thing just to throw out, which is I was listening to Jack Dorsey talk about Twitter and social media and tech, and he was talking about how in tech there's such an overemphasis on outcomes, and nobody talks about like the primitives or the primitives. They will band-aid the outcomes when things happen, but they won't talk about the principles and values behind it. And he gave the example of, I think he called it explainability. He thinks there should be a principle of explainability in tech where, Google has to be able to explain in plain English why, say, you got recommended a YouTube video, right? Mm-hmm. So that should be a regulation because it addresses the principle. It doesn't address the outcome, but it doesn't have like super clear, easy policy outcomes or anything like that. But it would be a step in the right direction. I think there is also an analogy for that over to tech or to finances, where a lot of people, a lot of what we've done in the last couple of decades seems to be band-aids and outcome based, where the government, some stupid 2008 crisis will happen, government bails out, puts in Dodd-Frank laws that increase transparency or whatever, but a lot of the intervention seems outcome based and not very well thought out. And I think there could be they could borrow some inspiration from that and have something like explainability. Like, why is it that you need to be able to invest in synthetic derivatives in the housing market in the US? Like, please explain who in the market is getting big value out of this. Like, who and how is society benefiting from this investment instrument existing? It's obviously not going to fix everything, but I think it would take a step in the right direction of if Wall Street had to explain themselves essentially and justify their value add to society in a more clear, fundamental way, they might actually there might be some sort of more incentive towards less complexity and actually working to present Wall Street in a favorable light and say, oh, this is what we actually contribute to society, and this is how we do it, and that actually might actually improve how they operate because they are thinking about those things more often.
I actually really like that approach. I wish Dorsey would take it more often with his own work, but I do think that that's a pretty good way, because you always run the risk of when you are legislating and regulating that you might make things worse, right? At least this would be a good intermediary step where you say, okay, you're going to need to explain yourself. And then we can actually have a real discussion over it, because it really opens up the whole black box a lot more. And that allows people to then say, okay, now I understand what's going on here, and I'm not in agreement with this at all, or I am in agreement with it. And then you can have the proper discussion around it, rather than it being, I don't know, I feel like when you don't have that, and you have that Band-Aid approach, it's just kicking the can down the road, right? And eventually those are going to come back, those chickens will come home to roost. But you might not even know exactly what caused that problem in the first place, because it's been, 10 years since it happened, and you can't actually draw the causal threads now. And it's to take that principles-based approach, it would be, while it wouldn't solve everything perfectly or instantly, I think it would go a lot further down the road than what the current solutions are.
I'll tell you what caused every crisis we're dealing with today. Some asshole in Serbia decided he was going to shoot the Archduke of Austria.
It's a pretty good
snowball
causal
effect.
thread.
Well, I don't think you're going to be in a congressional hearing about all Wall Street issues. I don't think they'll be sending you the invite.
Well, that's because they don't want the deep dive.
They don't want the.
They can't. They can't handle the truth. You and Alex Jones. You got Franz Ferdinand. He's got space aliens and gay frogs.
Take Franz Ferdinand every day.
I'm going with the gay frogs. It's more my style. Chemtrails and gay frogs. All right. Is there anything else, you guys?
That's all for me.
Alrighty. Well, yeah, that's it for me. All right. Thanks for listening, everybody. Peace.
Peace.